The National Bank of Cambodia expects the overall economy to grow by 3.9% in the year 2026, but the International Monetary Fund is less optimistic, recently lowering its own forecast for the country to an even 3%. That gap between projections matters, but the bigger concern is that these top-line numbers hide a significant divergence between individual industries. While the national average suggests modest growth, different parts of the economy are moving in opposite directions. Relying on a single 3.9% figure to guide your strategy is risky. Without looking at the sector-specific data, you may end up funneling capital into the very areas that are slowing down. The traditional engines of cash flow are stalled. Real estate and construction are trapped in a period of prolonged weakness. Any growth expected in the second half of 2026 relies almost entirely on export-driven manufacturing and agriculture. Foreign direct investment is currently bypassing legacy sectors, flowing instead into non-garment manufacturing and specialized production. This chart shows the migration of capital. Manufacturing and FDI are trending well above the baseline, while tourism and real estate continue to slide. Keeping capital parked in property or hospitality might preserve the physical asset, but guarantees a cash bleed in this high-cost environment. To capture any meaningful return in 2026, investors will have to move away from historical safe havens and align with these new industrial drivers. Shifting into manufacturing and agriculture can secure your top-line revenue, but it introduces a new challenge: severe margin compression. Operating costs are rising globally, and Cambodia is particularly sensitive to higher fuel prices, which impact every level of the supply chain. Regional frictions add to the cost. Prolonged border tensions with Thailand are creating sustained disruptions in cross-border trade and travel. When you combine high industrial electricity costs with fuel hikes and border delays, the profits for heavy manufacturing and logistics can disappear quickly. Simply operating in a growth sector isn't enough. Without structural defenses against these rising costs, operational inflation will consume the revenue you generate. The most effective defense against these costs is to structure your operations under qualified investment project status or within a special economic zone. This quadrant chart plots mitigation strategies, and QIPs and SEZs sit in the high-effort, high-impact zone. They provide the tax holidays and import-export efficiencies necessary to stay profitable. This status requires significant administrative effort and strict compliance, but in the 2026 environment, it is essentially the price of admission. Integrating into an SEZ creates the financial shield required to protect your margins from the volatile fuel and logistics costs we've identified. Administrative friction is a small price to pay for protecting your bottom line in Cambodia's shifting industrial landscape. Navigating this shift requires capital, and the Cambodian banking system remains sound, supported by macroeconomic stability and regional cooperation. The scale of support is significant. Banks have restructured over 239,000 loan accounts worth $4.8 billion, while maintaining a stable non-performing loan ratio of 3.3%. Leveraging these facilities provides the liquidity needed to survive a slower growth environment, though it does subject businesses to strict financial stability audits by the central bank. But as businesses lean on the banking sector for stability, they face an emerging threat from outside the financial system: a rise in technology-related scams. In an environment where every percentage point of margin counts, losing capital to a cyber scam can be a terminal event for a business. Success in 2026 requires a two-part defense: using the stable banking system to maintain a conservative balance sheet while protecting that capital through increased investment in cybersecurity. Turning this complex economic analysis into a concrete action plan requires a clear strategic roadmap for the second half of the year. Your first step is to identify your primary asset. Are you allocating corporate capital or your own labor? For capital allocators, the instruction is clear: halt expansion in the hospitality and real estate sectors immediately. Reallocate that capital into non-garment manufacturing and agricultural technology to align with current FDI trends. Ensure this pivot is supported by QIP or SEZ status to prevent operational costs from eroding your returns. Passive returns are a thing of the past. Strategic, administered alignment with Cambodia's industrial goals is the only viable path for growth. For professionals and expatriates, the path is different. Your most valuable asset is your time. Staying in construction or tourism leaves you vulnerable to the downside risks identified by the IMF. However, there is a critical skill shortage in the manufacturing and agricultural sectors that are currently driving the economy. Upscaling into logistics, agricultural tech, or manufacturing management will provide a massive competitive advantage as these sectors expand. Regardless of your career, budget defensively. Higher fuel prices mean transportation and daily costs will remain elevated for the foreseeable future. Success in 2026 means moving past legacy industries. Whether investing millions or your career, you must pivot aggressively toward Cambodia's industrial future.